Good afternoon, friends, and welcome to Taking Stock on Vox Markets. We've got plenty of updates again today, which being a Tuesday, typically quite a busy day for updates. So we've got the likes of the Hut Group, GB Group, Videndum, Watkin Jones, AB Dynamics, Tiny Build, 88 Energy, and lots more to cover. So thank you very much for joining me. If you're new, please subscribe to the channel. If you are a regular, I hope you will continue to give the thumbs up because it really helps the show. Thank you for all the comments. As always, we've got George and Hasib in the live chat. Thank you for your comments in the live chat and under the replay. Really appreciate it. Okay, so let's get going with the Hut Group. And by the way, if you're watching this on replay, we do have timestamps, so you can skip ahead to the sections that you're most interested in. They don't go up straight away, but they do go up typically a couple of hours after the broadcast. Okay, so George is asking about RWS. Yes, I am planning to have to make some comments on RWS in a few minutes. But let's get into it. Here's the Vox Markets website. Let me just move things around a little bit here, and we'll go straight into the Hut Group. So THG, as it's known. And this is a variety of businesses: beauty, nutrition, and something that they call ingenuity. I am on record as being a bit of a skeptic when it comes to this one, due to the lack of profits and the focus on adjusted EBITDA and revenues. However, let's, as always, try to keep an open mind. The shares are up by 5% today. And it's quite a big company in market cap terms, the best part of £1 billion here, 863 million. Today's trading statement is quite bullish. They talk about group revenue growth accelerating to 4.5%. I think that will be a bit of a theme today, actually. You know, we're in April. A lot of companies struggled in 2023, but it seems like in Q1 updates generally seem quite positive on 2024, that 2024 has started out better and we're on an improving trend. So we've got, according to THG, we've got growth progression in each of the past 5 consecutive quarters, and they're particularly pleased with the performance of THG Beauty. Now, THG Beauty is described as a very large and important beauty business. I guess part of the problem for me is I'm not the target audience. You know, I never heard of the website called Look Fantastic, which is within THG's portfolios, and there are other brands that they own and websites. I'm simply not familiar with them. They do seem to be quite big. You can check them out on Trustpilot. You can look up the Look Fantastic reviews, and on other review websites. They do have plenty of customers, and you can see the revenue here is significant at £267 million. So it is a decent sized business, and they're quite pleased with this 11% growth in revenues. Nutrition struggling. They are rebranding the My Protein brand, and that is kind of going through a sort of a period of transition. And then we've got this Ingenuity product, which is designed to help other brands with logistics. So overall, I mean, 4.5% revenue growth. It's difficult to describe that as fast growth, especially when there's still some inflation knocking around. So not a fast growing situation here really, but better than it was before. Uh, and very positive commentary here. Although, as someone who has been a little bit skeptical of the company, I will, I tend to expect very positive commentary. So we've got a breakdown here. We don't need to go into all the details, but we've got a breakdown of beauty, and we've got breakdown of nutrition. So this My Protein, now that is a brand I am familiar with. I have seen this brand, and that is probably worth that probably would sell well if they were ever to spin it off. A well known protein brand, but they're doing this rebrand of My Protein, the biggest in its 20-year history. And so they've got 40% of products available under the new branding. So that is going to take some work, and we'll see how that works. And various other risks mentioned here, fair enough. And then we've got this Ingenuity product, which has grown a little bit as well. In terms of the outlook, expectations are unchanged. Group revenue growth in H1 is anticipated to be in the range of +2 to +5% on a continuing basis, moving towards high single digits in the second half, reflective of the onboarding of new contracts, etc., etc. So still not high growth, I would argue. You can. I'm pretty much a perma bear on this stock, so you have to bear that in mind. Ask somebody else, and they might be very excited by all of this. But +2 to +5% revenue growth, still pretty low on a group basis. Of course, some parts will be a lot better than that. And then in terms of the CEO comment, he's obviously pleased with progress that's been made, and he says the response to the My Protein Elevation rebrand has been fantastic. While these changes naturally impact short-term revenues, the strong positive response underpins confidence. So probably, I guess we can call this a win for the Bulls, with a decent update from the Hut Group. Long-term skeptics such as myself will probably remain skeptical. But well done to THG for posting that revenue growth, and hopefully not just the Hut Group, but lots of other companies will see revenues accelerating across the rest of the year. So let's move on to RWS. George in the live chat was asking about this one. And Jonathan is asking about Jupiter. I have covered Jupiter in detail on Stockopedia. So in fairness to Stockopedia subscribers, I won't cover it in detail here. But I will say very briefly that I remain bullish on Jupiter. And I'm, how would I say, today's update, I feel, didn't really give much hope of inflows happening in future, but who knows? I mean, I still think the stock is very cheap, and and AUM isn't shrinking. So there you go. Okay, but do check out Stockopedia for more, because that's where I covered it in detail this morning. Okay, so let's hop over to RWS. RWS. So these shares are down 11%. This is a world leader in translation and localization, intellectual property support solutions, and life sciences language services. So I think perhaps one of the main controversies around RWS may be, and I don't claim to be an expert on this company, but I think where people may disagree is on artificial intelligence, and whether artificial intelligence is ultimately going to be a good thing or a bad thing for RWS. Because when you are doing something like translating, and the an AI bot can do that for you instantly, it does sort of I mean, it's a huge change. It's a revolutionary change in how translation is going to be done in the future. So you may still need human input, but you may need less human input than you did before. So we've got this trading statement from RWS. So important to remember what they do: technology-enabled language, content, and intellectual property services. So now this is my theme for today, probably, is that while revenue growth for many companies remains limited, there is this sense that things may have bottomed out. So we have organic constant currency revenues down by 2% in the period, an improving trend compared to the prior year. So I guess we have to be a little skeptical when companies are talking about the second derivative, so things are still deteriorating, but the pace of deterioration is falling. But having said that, look, let's give credit where credit's due. It's a small decline in revenues on an organic basis. Reported revenue down 4%. And they say they continue to see soft activity levels from certain market segments, but they're encouraged by growth in two of their divisions. I was looking a little bit at the history of this company because it's not one I look at very often, but the history of it does involve a lot of mergers and acquisitions. So it really is a group of many different businesses, I would say. You can see, quite a few different divisions and businesses inside here. They are related, but separate. In terms of profitability, there is a significant fall off from £54 million in H1 last year to £45 million in H1 this year. So that's the expectation. As we saw, the shares here are down today, and investors are a little bit disappointed with the news. There is weaker performance in some parts of our higher margin businesses, an unfavorable mix of work, and foreign exchange issues, ongoing investments, and so on. So lots of reasons for profits to fall. And they continue to drive incremental revenues from their growth initiatives. So let's see what they have to say about artificial intelligence. They've got this thing called Train AI. They've also got Evolve, which is a pioneering linguistic AI solution. It combines language services expertise with translation management system and neural machine translation technology. So a bit of a word salad there for a non-expert like myself. So lots of big words here to understand. But they say that this is going through proof of concept, and they anticipate that it will contribute to revenues and become an important part of our AI-enabled services portfolio. So obviously an early stage initiative there, but trending towards revenues. They say there's progress in linguistic AI, and they're developing various things and rolling things out. So look, plenty of work going on at RWS. I'm sure it's a fine business, but revenue's clearly under some pressure, and they're responding to the AI landscape proactively. But it does remain to be seen how all this is going to work out. The CEO says that they are well positioned to for clients' increased appetite to harness AI to meet their language and content needs. And they say that they do have proprietary technology, but if you want to ride the artificial intelligence wave, there's obviously plenty of other companies that are growing quickly that might enable you to do that. Like, so for example, I own shares in Alphabet, other people own shares in Nvidia. So there's plenty of AI companies out there where it's clear that they are working and have AI technology. The case of RWS, not entirely clear to me that that AI is ultimately going to be a positive for them, but we'll have to wait and see. If anybody, George, anybody in the live chat wants to let me know your thoughts on RWS, please let me know. My views on this topic aren't fixed, and happy to revise my view in response to more expert comments. But that's RWS, another decent sized company, £600 million there. Okay, let's scroll on over to GB Group. So we're doing all the big companies. We will get to some smaller companies soon. This is another big one, £750 million market cap. This is in the business of ID verification and fraud prevention, and so that's obviously going to be in high demand in the current economy. And we've got a trading update here, which is positive. Sorry, let me just remind us, the shares are up by 16% today. So we've got some positive news to look at here for once. And we've got adjusted operating profit above expectations. So happy days for GB Group shareholders here. They say they expect to report revenue of £277 million, driven by growth accelerating in identity during Q4 as anticipated, with adjusted operating profit slightly ahead of the top end of current analyst expectations, reflecting the excellent progress achieved throughout the year to drive simplification and cost effectiveness. So it's not really revenue that's responsible for the beat here, but it is honestly, I don't care if a company wants to beat expectations with revenue growth or by cost cutting. I'm happy with both. I suppose if we're totally honest, you'd probably prefer to see revenue growth because of the implication for the long-term value creation, but still a fine achievement here by GB Group. And we've got Q4 growth of approximately 5% on a constant currency basis. And we've got expected adjusting operating profit of approximately £61 million. So hopefully that will translate very well into cash flow and in real statutory profits. They do say that there was strong cash generation in the second half, with net debt of £81 million, better than current analyst expectations. I did have a little look at the company's historic financials, and I figured that the net debt here was quite reasonable, and they've beaten expectations on that front. So hopefully the cash flow performance will be as good as promised. It certainly sounds as if it was. And in terms of the outlook, they expect mid-single-digit revenue growth on a constant currency basis, which will drive high single-digit growth in adjusted operating profit. So lots to be happy with here. You've got operational leverage as well going into the new year. Always very nice to see that. And very difficult to complain about anything in this trading update. The CEO says, "We have begun the new financial year with good operational momentum, and our confidence is underpinned by the strong fourth quarter performance, and they are prioritizing competitive differentiation and a high performance culture." So I like the story here, and I do view this as being in a little niche that should experience good growth over the long term. So hopefully they will remain as competitive as they currently are and keep keep plowing ahead. But it all looks very nice at GB Group. Okay, let me just scroll back. We've got a comment from George, who says that he holds RWS. He says, I still, like you say, remain unclear if artificial intelligence is good or bad for them. I think I'm starting to lean towards the latter with their last few updates. Well, it's always important to keep an open mind, whether you hold a stock or you don't, to just remain open to the possibility that you could be right, you could be wrong about any stock. And unfortunately, I probably don't change my mind often enough out of stubbornness. That's probably a character flaw. Okay, let's move along to a few other things. We've got so much to cover today. I imagine we're going to run out of time, but we'll see. Let's head on over to Watkin Jones. So this is a developer of residential properties. And now we're in a slightly smaller segment here, £110 million market cap. So that's definitely a small cap rather than a mid cap. And the update here is pretty good. So the shares are up 6%. So we do have a nice bit of positive news to look at today for a few companies. So this H1 update says that H1 performance has been driven by contractually secure forward sold developments. I think that's a key feature of the stock or of the company, that forward selling is a big part of the strategy, taking elements of risk out. Project margins at 10% have been in line with guidance. They've forward sold a 260 bed purpose-built student accommodation scheme in Bristol. And the underlying operational residential for rent market continues to perform well. So I do take an interest in the property market. Another company I studied this morning for Stockopedia was Property Franchise, and it sort of feels like 2024 could not be any worse than 2023, and will probably, fingers crossed, be a bit better. And especially in the rental market, rents and lettings have been incredibly resilient. It's obviously bad news for renters, but rents seem to be continuing to increase at pace. And with the sales market struggling, then I suppose you can argue that is going to increase the demand for properties to rent. So we've got this, Watkin Jones, you would think would be quite well placed, being that it is focused on building properties for rent. So they do say that they expect performance to be H2 weighted. That always makes people a little nervous, but it reflects the timing of forward sales targeted to be completed. They've been proactive in the land market. So they've got large student accommodation sites that they're working on for future delivery that are subject to planning, and various other points here. So I think I'm pretty positive on this one. They've got net cash of £44 million with a market cap of £105 million. That's covering a significant chunk of it. So I don't think I can argue against this share very, very easily. Seems like at £110 million, it should be should be worth looking into. So I'll be going to keep a fairly positive view on that one. Now, I feel obliged to take a look at AB Dynamics, ABDP, because it's one of the highest quality companies that I think it's possible to find in in the London market, but it's always terribly expensive. Market cap here, £423 million. The shares are almost unchanged today. We've got a half-year report, and you can see that they've got an excellent conversion of adjusted EBITDA into profits, very little difference. And then adjusted cash flow from operations is higher than EBITDA. And it's just very difficult to find any flaws at AB Dynamics. A nice net cash position as well. I mean, that's not quite 10% of the market cap, but it's a decent amount of net cash for the company. And it feels like they've really managed the transition to electric vehicles very well. This is a company that provides testing services to the vehicle market. So they've got things like a pedestrian dummy that they use. They've got various new products that they're working on, durability testing solutions, and a pedestrian detection system, various things that they're working on, and it's all very high growth, I would say, and they just seem to have mastered this niche. So very difficult to find any flaws in performance. It's just a question of, are investors willing to pay up, because the stock rarely seems to be on sale. Let's take a look at the current trading and the outlook. Performance in H1 was strong, good conversion of orders to revenue, a solid order book with good visibility for the second half of the year. Mindful of the timeline of pipeline conversion and customer delivery schedules, they are confident that the first half margin can be sustained, and they expect to deliver full year adjusted operating profit ahead of current expectations. So it's not enough that their financial performance is so good, they also have to beat expectations. So I mean, it's just got an amazing track record, this one. But let's see what sort of financials we can pull up here. Okay, so we've got numbers to August 2023, and you can see revenues 100 million, operating profit 12 million, pre-tax profit 11.5 million. So that's the catch. That's the drawback. That the company is valued at over 400 million pounds. It's a very heavy price to pay. It's a big price to sales multiple. It's a big price to earnings multiple. So it's just very expensive, but a very nice company. Maybe, and this is just an idea, but maybe it's the type of thing that somebody would accumulate gradually over time, so as not to overpay too much for it. But a very nice business. So that's AB Dynamics. Okay, let's head on over to the Vox Markets homepage here. I wanted to check out Paul Hill, who has written an article with Alecosoft, Aleco. So this is a software developer, and they've produced inline results for 2023. So this is a company I'm not too familiar with, but I would recommend that you check out Paul Hill's content. Paul is a big believer in this one, and take a look, and you'll get all the details from Paul Hill on that one. Okay, I feel I should mention 88 Energy. Somebody in the live chat wants my favorite stock at a reasonable price. Well, I put I put 10 stocks on my best ideas list for 2024 over at Stockopedia. I did the same for 2023, and I had a big short list of stocks that I whittled down to get to my top 10. So I would say that is probably the best place to start if you want my favorite stock at a reasonable price, because if I was to just shout out a ticker code, I don't think it would do justice to my reasons. Okay, but thank you for the question. Okay, let's mention 88 Energy. This is one where they've had quite a few updates recently. And I have been mentioning these updates in passing. We've had all these positive results. You can see we had an update. We've had, how many updates have we had in April? 1, 2, 3, 4, 5 updates of different types in April, a few in March. And yeah, so this one does tend to give us quite a lot of updates. I've never pretended to be an expert on the company, but I noticed that it was on the most read list, the most read RNS list regularly, and I see today we have a placing. So this just sort of goes with the territory, with small caps, and especially with the sector, and you get positive updates, and then you often get a placing not too long after. So the shares here are down 16%. They're raising Australian dollars 10 million, which is £5 million approximately. So that's not too much dilution, you would think, if they're only raising £5 million. So look, it's what can I say? It's an energy project. They need funds, and it just goes with the territory, especially in the small cap sphere. So I'll just leave it at that. But at least they have managed to get this placing into. They've managed to hopefully managed to get it away and work on their projects. But that is 88 Energy. Let's mention TinyBuild. I am a fan of the video game sector, but this is in the indie space, and I've been making some comments recently. You've been watching my videos. I've been pointing out that there's a big difference between investing in the indie video game sector versus the flagship or blockbuster video game space. So let's see what we've got here in the RNS. Preliminary unaudited results. So some pretty big losses here. And unfortunately, this one just hasn't really worked out for investors so far. And we've got the shares down another 20% today. So, clearly there's disappointment. Interesting though, when you look at the outlook statement here is not too bad. They're saying that the pipeline for 2024 and beyond is strong. This includes a number of larger budget, high potential games. Now, in the indie game sector, above $1 million is considered almost big budget. Obviously, it's not big budget compared to other video game developers, but they're positive on the pipeline. They say the implication of the conflict in Ukraine, they're keep an eye on that, but they are confident that the company is on track to deliver results in line with expectations. So with that outlook statement, you would have some optimism. The CEO has this to say: it was a tough year, demonstrated the importance of having a strong back catalog and investing in long-term sustainable franchises. We see early signs of success in our shift towards the 1,000-hour game, and we will continue to experiment. Um, so, look, it's hard to dress up these results. We've got a huge operating loss, a huge loss before tax. There was 10 million plus of operating cash flow, and they finished with a small net cash balance. So I suppose the concern here is that they may find that they just, the balance sheet could remain under some pressure. They had $26 million of cash in December 2022, and that's fallen all the way to $2.5 million. So that is, it's obviously not sustainable to burn cash at that pace. In January 2024, they did raise $12 million of cash. So that means that at the end of March, they had high single-digit millions. However, this is anticipated to reduce towards the half year. So I think it's reasonable for shareholders to be concerned about the rate of cash burn, and that this could need more funds at some point. Hopefully not this year, but if they continue to burn cash at the rate they've been doing, then they may, in my opinion. So we've got a resignation of the chief commercial officer as well in March. We'll have a little look at the cash flow statement if we can. So we've got net cash generated by operating activities of $11 million, but we have net cash used in investing activities of $33 million, including $32 million of software development costs. And you can see the previous year also had an enormous cash outflow from investing activities, with over $40 million spent, and $36 million was spent on software development costs. So the problem is basically they're spending a huge amount on software development, and the operating cash flow is just not matching it. And so, I mean, it's obviously not sustainable. Something's going to have to change. So I am a bit worried about this one. Even though they've raised cash recently, the rate of burn there is just too high to be sustainable. So hopefully they'll turn it around. But yeah, I'd have concerns there, and I'm not surprised to see that the market cap is only 10 million, because they really need to change what they're doing. Okay, so that's TinyBuild. We've had so much to look at today. Let's head on over to AWE. So this is AlphaWave IP. Now we're back. This is another decent-sized company, over 800 million pounds. AlphaWave IP Group. So this is basically a semiconductor company, a very high-tech semiconductor company, and let's go hop straight into this Q1 trading and business update. So the shares here are up today by over 1%. Now, this is one of the sectors where I do not claim to be an expert, but let's just point out that they've got new bookings up 20% in US dollars, which sounds very positive. And the chief executive officer says, we started the year with another strong quarter of bookings in excess of 110 million US dollars. We achieved several exciting new wins during the year, and we've got artificial intelligence mentioned again. This includes 2 AI custom silicon designs for a Korean and North American customer. Customers' demand for our high performance custom silicon and IP remains strong, and the level of Q1 bookings underpins our confidence for the year. Look, this is a high-tech company. Customers include leading semiconductor device companies as well as data center module makers and hyperscalers. And if I was going to study artificial intelligence as a theme and try to pick out artificial intelligence stocks, this is the sort of thing that would interest me, where it's clearly very high tech, and what it seems to be cutting edge. Again, I'm not an expert, but this seems to be a cutting edge company, a global leader in high speed connectivity for the world's technology infrastructure. So I would say this one is worth studying. I am sorry I'm not an expert in the sector, but I think this one does seem to be a very interesting business. In terms of profitability, sadly, we've got a net loss of $51 million for 2023, but adjusted EBITDA positive $63 million. So you'd have to investigate what is going on there with the big difference. But yeah, I just thought I'd mention that one in passing. Not one I'm an expert in again, but a good seems to be a cutting edge company nonetheless. So that's AlphaWave IP. Okay, let's hop on over to Videndum, VID. This was previously known as Vitec, VITEC, and it provides hardware and software for content creators. So content creators such as people who produce YouTube videos on live streaming, for example. And it's 260 million pound market cap. Share price a little bit disappointed with today's news, but not much. So this company has been affected by the strikes in Hollywood, but those strikes are hopefully in the past now, and we won't see anything like them ever again. A dual strike by writers and actors. And so that's the context in which we have to appreciate these results. We've got a very large fall off in revenue from 2022 to 2023, a total collapse in profitability from 60 million pounds to only 1 million pounds of adjusted profit before tax. So it's understandable, and I would say totally reasonable to have a bad year when there's a strike. They also mention a challenging macroeconomic environment and destocking, which many companies have mentioned as a problem. I have mixed views about the destocking reason, because it feels like a bit of a fad that so many companies have mentioned destocking. But then if they all mention it, then I don't think they're making it up, but it's just a strange term that's taken over business commentary over the past year. Anyway, destocking is mentioned. Revenue 31% lower. So I mean, look, the results are terrible, but maybe it's not worth focusing on them because they're not representative of the future. So there's no point in focusing on them. Hopefully, we will have a big upturn in the years ahead, because it's not normal for revenues to collapse this way. We should point out that leverage is too high as of the end of 2023. It did improve in Q1. So leverage became 122 million pounds with a leverage multiple of 3 times. Now, hopefully, you'll remember that three times is for me the limit of acceptability. So they've just managed to get to an acceptable leverage multiple. They're well below the covenant limit of 4.25 times, and they are prioritizing reducing leverage to get below 1.5 times. And below 1.5 times is, in my view, totally reasonable for most companies. So that is a problem, a real problem. They need to improve that. I imagine that improving EBITDA will be one of their main, will be their main way to reduce the multiple. You can reduce multiple by paying down debt, or you can reduce your leverage multiple by increasing your EBITDA. I expect that Videndum will be doing the latter. In terms of the outlook, they say that there's been a significant pickup in, I presume that's cinema and scripted TV market. However, that pickup did not materialize and is now expected from June. So that's a problem. The macroeconomic environment affecting the consumer and independent content creator segments remains challenging. Nonetheless, management believes that the rate of decline is starting to show signs of improvement and that destocking is largely completed. So again, many companies used destocking as their main excuse last year, but equally, many companies now say that destocking is over or is nearly over. So Videndum is saying what many companies are saying here. They also mention artificial intelligence, AI, autonomous presenter tracking software, and speech recognition. So that's what they say. They say they have market-leading robotics and AI technology, which is driving cost efficiencies for studios. So overall, it's below expectations in Q1, but leverage did reduce, and they're confident of a strong recovery in H2. So, I mean, overall, I would say that this is a pretty reasonable update. I do not think last year was representative of the future for Videndum, and they do seriously need to get that leverage multiple down. It is at 3 times, which is just on the cusp of respectability. They get that down to 2 or 1.5 times, and I think they'll be sitting pretty. You can see the share price has had a huge drop off here over the past year. But an interesting one that could be a recovery play in the years ahead. So Videndum there, I think, is worth a look. Okay, so we've covered plenty of stocks there. I think I'm going to call it a day there. About 50 minutes into the broadcast, and those are the main stories for today. A few other little bits and pieces I don't think are of great interest. Please, if you've enjoyed the show, hit the thumbs up. Really helps me out. And I appreciate all the comments in the live chat. George, Jonathan, and Hasib. And please continue to check out my Twitter profile, Graham Neary, where I post links to this video each day, and also Vox Markets on Twitter at Vox Markets, where you get links to this video and all the rest of the news that goes up on Vox every day. Okay, folks, it's been a pleasure. You're very welcome, Steve, in the live chat. Have a good afternoon. Enjoy the rest of your day, and I'll see you tomorrow. I'll leave you with the outro. Okay, thanks very much. Bye for now.